Welcome to Chapter 11. In this chapter, we will combine two closely related topics, current liabilities and payroll accounting. So, what is a liability? Let's just kind of take a step back and talk about that. We had some sort of transaction in the company. We bought something. We used utilities. Something like that occurred. And now we owe money, but we haven't yet paid for it. So what the liability does is it represents a purchase or a resource that we have consumed but not yet paid for. Liabilities are classified as being either current or long-term liabilities. A current liability, the basic rule of thumb is anything we're going to have to pay in the next year. You'll notice on your slide it says or the company's operating cycle, whichever is longer. So if you have a company that has a 2-year operating cycle, then it would be the 2 years that would define whether something constitutes a current or a long-term liability. The long-term liability is, by default, anything that comes due after a year or the company's operating cycle, whichever one is longer. There is one little caveat I want to mention when we talk about long-term liabilities. Most long-term loans for buildings, equipment, vehicles, things like that are going to require monthly payments all through the life of the loan. You could certainly have a loan where no monthly payments are due and you just have to pay a balloon payment at some later point. But chances are you're going to be on your long-term loans making monthly payments. Any payment that is due within the next 12 months is going to be considered current. So our long-term liabilities can be broken down essentially into the current portion of the long-term liabilities, which is any payment that will come due in the next 12 months. And then you will have the rest of the long-term liability within the long-term liability section on your balance sheet. Now, to record liabilities properly, we need to know 3 things. We need to know who to pay. We need to know when that they need to be paid, and we need to know how much to pay them. Now, we will have known liabilities, and then we'll talk about contingent liabilities a little bit later on, but for now we're going to talk about liabilities that we can quantify at the time the transaction happens. So when we buy something from a vendor, we know how much that is. Sales tax that we collect from our customers, similarly we know. Anybody who has prepaid us for services, any notes that we owe money on, we know what our payroll is, and any multi-period, so basically the long-term loans, we know what the current portion of those payments, those liabilities are. Let's take a look at sales tax because this is an area where students often get confused. We collect sales tax on behalf of the taxing authority from the customer. That money is not part of our revenue, and we don't want to include it as revenue. We want to have that segregated from our revenue right from the get-go. So in this case, we've got a 5% sales tax, $6,000 sale. So the sale is going to be $6,000, and then there's going to be an additional 5% over and above that that's recorded for sales tax payable. We will collect a total of $6,300 from this customer. Now, ideally, you are taking this $300 and you are making sure at the end of the day that all of the sales tax that you have collected from all of your customers gets moved into a separate segregated account that does not get touched until the sales tax return is due and that money gets sent off to the state. Many times I have represented companies that failed to do that and basically spent the sales tax money as if it were their own funds. And then the quarterly period to remit the sales tax rolls around and they don't have the money. And those are what are called trust fund taxes. And the government takes a really dim view of you using their money to operate your business. So it's a really fast way to get not only the business in trouble, but the individuals who were supposed to be paying over that money in trouble as well. Here's an example of how we would treat unearned revenue, or essentially if we've been prepaid for a product or service that we have yet to deliver. In this case, we've got $900,000 that we sold of tickets for various events. So we had the cash come in of $900,000 and the credit goes to unearned ticket revenue. Now we get to October 31st, one of the events happens, so now we have earned that. If the concert had been canceled, we may have had to have refunded that money, so we wanted to keep that money in the unearned ticket revenue until we no longer potentially would owe it back to the ticket purchasers. So after the October 31st concert, we come in and we say, okay, this is now 300,000 of this is earned money. We are going to transfer that from unearned ticket revenue by debiting that and crediting ticket revenue. Next, we're going to look at recording of short-term notes payable. Now, typically when you see a short-term note payable, it's probably going to be from a bank, but it doesn't necessarily have to be. There could be an instance where, and I should talk about the difference really between an accounts payable and a notes payable. An accounts payable is an arrangement that we have with a vendor where we're going to pay in full in 30 days, and it's probably a revolving type situation where we're buying and paying and buying and paying. A notes payable is a contract. There's a fixed amount that's owed. There are payment terms. There are potentially interest rate or interest associated with the payments and dates in which those payments are required to be made. So why would you have a note payable if it's not from a bank? Well, maybe we're having some financial difficulties and we owe some of our vendors and we know we're not going to be able to pay them. And maybe it's gone 30 days, 60 days, 90 days, and they're becoming a little tense with us. We may reach out to them or they may reach out to us and say, hey, we need to remedy this payment default situation. Let's try and see if we can cure this, spread it out into smaller payments over a period of months. Interest will be attached to it, and we're going to do a formal contract to reflect that payment arrangement. And so in this example, we're doing it as though we are the party who couldn't pay. But we could, if we were on the other side and we had a customer who couldn't pay us, we could very easily do this from our side of it as the vendor. So in this case, we've got a vendor by the name of McGraw that we can't afford to pay. So we've owed McGraw $600 for a while, and all we could come up with was $100 to pay McGraw. So what we did was we said, okay, we're going to have a note and for the remaining $500, and it's going to be at 60 days, 12% interest. And so that's going to remove the accounts payable from our books and convert it into a notes payable for the remaining $500 that we still owe them. And so now we're going to pay them. This is not a situation in which they had monthly payment terms. It's just that the whole thing is due in 60 days. Now there's interest associated with that. So not only do we owe McGraw the $500, but $10 in interest. So we're going to pay them the $510. That will reduce the notes payable of the $500 that was owed, and we'll have an interest expense of $10. Now, in our last example, the payment that we had to make to McGraw, and the note was all signed within the same year. You know, the note took place on September 30th. We paid 2 months later on November 29th. And assuming a typical calendar year end, we didn't have to worry about a year-end financial statement adjustment. But what would have happened if instead of taking this money out on September 30th, what if we had actually taken it out on November 30th and then didn't owe the money wasn't yet due until January? Well, our financial statements are going to close, and we're going to need to issue those on as of December 31st. Because money has been owed during the entire month of December, in my little modified example, some interest will have accrued by the close of the financial statement, the accounting period, and we need to reflect that interest. That it's not yet due because it's not due till the payment is made, but it has accumulated, and therefore it constitutes an additional liability that we need to account for on our books. So December 31st, we're going to record an interest expense of $10 and then interest payable of $10. Now, and they're assuming a due date of February 14th, and they're going to now pay the entire note that has come due. And so what we need to do is we need to record the new interest expense that goes from December 31st until February 14th, the date the payment is made. So that's 45 more days of interest that we need to take an expense for. And then we're going to reduce the interest payable for the $10 that we had already taken the expense for back in December, so that when we pay them the $2,000 that we owe them, it's going to reflect a cash payment of $2,040. I'm going to stop this video here and move on to the next one to talk about employees and payroll.